If you want to invest in real estate, it's not just for millionaires. Anybody can do it via a real estate investment trust or a REIT. Now, in this video, what I'm going to discuss are the different types of REIT, but also the individual funds which give you exposure to that asset class and what you pay for them, because some of them are quite expensive. So remember, if you like learning about investing, then why not join us on Patreon? There'll be a link at the top of the page and also in the description below. And if you do that, you get access to the chat application Slack, where you can ask questions of me or other members of the community. And you get access to our live webinar, which is regular. And you get access to an increasing library of members-only videos. So now let's look at REITs in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. A REIT is a real estate investment trust. A REIT is a fund which allows you to get exposure to the real estate market. So let's imagine we have a property portfolio, which in itself may be worth millions. You may not have enough capital to buy that entire portfolio of properties. But the important thing about those properties is that they generate a cash income. So by pooling your capital into a REIT, the REIT can buy that portfolio of properties, and then that income is fed back into the REIT and redistributed to the shareholders in proportion to their holding of the REIT. Now, the primary benefit of a REIT, both in the US and in the UK, is that it gives you a very tax-efficient way to invest in real estate. Although the criteria are slightly different, there are certain commonalities. For example, 3/4 of the assets have to be in the real estate market, both in the UK and the US. 3/4 of the income also has to come from property, and 90% of that income has to be paid to shareholders, rather than being retained by the REIT itself. An important part of the governance of a REIT is its board of trustees, and that provides you with a safety net because they ensure that the fund doesn't do anything too crazy. In order to ensure that the control of the company isn't concentrated in too few hands, the US has a minimum limit of 100 shareholders in the REIT. That doesn't apply in the UK, but in both countries, no more than half of its shares can be held by 5 or fewer people. If you're in the US, REIT.com provides an amazing source of information about the US REIT market. And it also publishes these indices, which are the FTSE REIT US real estate indices, which is incredibly useful to look at the actual returns that you'd get historically from this asset class. The indices themselves are created by FTSE Russell, and you can also find a description of the indices on the Russell website. In case you were wondering, NAREIT is the National Association of Real Estate Investment Trusts in the US. You can broadly split the US REIT industry into 2 types. Equity REITs are the most common type, and depending on the sector, they can buy a wide range of income-generating real estate assets. So that could be resorts, hotels, shopping malls, data centers, timberland or forestry as we'd call it in the UK, and a wide variety of different types of infrastructure. Mortgage REITs, on the other hand, are more concerned about financing of real estate. They either make their money from originating mortgage-backed securities, which are bundles of mortgages, or they may actually retain the mortgage-backed securities and then simply earn the income generated by those MBS, as they're called. And the type of mortgages can be either residential or they can be commercial. And mortgage REITs tend to be more focused towards income, although it's not really clear-cut. Some people also buy equity REITs because of the income they generate. The REIT industry can be subdivided into many different subsectors according to the type of real estate which is purchased. And alongside each of these categories, you can see how many funds are in that category, as listed on the REIT.com website. Now, according to the macroeconomic environment, different sectors will have different performances. So, for example, retail is struggling at the moment, and it was even before the COVID crisis, because of the transition to online retail. Whereas data centers, which provide server farms for tech companies, have obviously done quite well throughout the crisis. You can also get historic data from REIT.com, and there's a link to where I got this data from here at the bottom, and they provide total return data going all the way back to 1970. And here I've plotted 2 of the series which they publish. Equity REITs at the top have generated about 12% over that 50-year period, whereas mortgage REITs have only generated about half as much return. You may also notice that this curve tends to be tailing off, which suggests that the returns that you got in the 1980s and 1990s were larger than those in the last 2 decades, and we'll come back to that topic at the end of the video. If we want to make a comparison of volatility and return, we have to use a shorter time series, because the REIT.com data was annual. So I thought here I'd compare REITs in the form of the iShares Global Property Securities Equity Index Fund with a straight S&P 500 Total Return Index, where dividends are reinvested, and a Total Return US Treasury 7 to 10 year ETF. Over the last decade, Treasuries have only generated about 4.3% return. The S&P 500 has had an incredible run, generating about 12.4%. But this hasn't been such a great decade for global REITs, which have generated about 7.5%. Now, because REITs tend to have a high income, people think that they might be like bonds. But what we can see on this graph is a risk-return plot that shows that that's simply not true. So I've got risk on the bottom, and you can see high risk on the right and low risk on the left. So you can see treasuries of fairly low risk here on the left, and equities high risk here on the right, but it also has a high return because it's high up on the return axis. Notice how the risk of the REITs is very similar to the risk of the S&P 500. They're both crowded at the right-hand side of this graph. But for this particular REIT fund, the return has been far lower than it has been for the S&P 500. And if we add the life strategy funds, which tell you what a diversified portfolio would look like as we increase the amount of equity, you can see that for this level of risk, you could get a significantly higher return even with a globally diversified fund. And also, that's for less risk. So now let's look at some of the US REIT ETFs which you can buy. There's a huge variety of passive funds which track the REIT universe, and many of them track the FTSE REIT indices or their subsectors. There are also global REIT indices and also regional REIT indices. So if you have a big appetite for risk, then you might consider something like an emerging market REIT, or if you want to keep it safer, you might go for developed market REITs. It's also interesting to look at the expense ratio for REITs. Some of them tend to be quite expensive. But what's interesting is if you plot the size of the fund, which is on the y-axis, versus the cost of the fund on the x-axis, it splits up quite nicely into 3 groups. The small and expensive group, the bigger and intermediate expense group, and then a very cheap and very large third group. But the one fund which really stands out in terms of assets under management is the one managed by Vanguard, VNQ. In case you wanted to look up what those tickers stand for, here they are sorted by the size of the assets, with the Vanguard Real Estate Index Fund being by far the largest, and these are assets in millions of dollars. Vanguard is so much bigger than the others that I've zoomed in on the y-axis by creating a log plot, and you can see the importance of having low fees. It's certainly drawn a lot of capital into these relatively cheap funds. So if the fee is more than about 0.3%, you've really got to ask what it is that that fund offers, which these cheaper funds don't. If we do a correlation analysis to produce a Scooby-Doo tree, which you've probably seen if you see the videos on my own portfolio, this is a really nice way of visualizing correlation between funds. So 2 funds which are very close together on a tree are REM and MORT, and notice how those are both mortgage REITs. What this tree lets you do is to choose funds which aren't correlated with each other by looking for funds which aren't close together in the tree. So you'd never choose REM and MORT together, because then you're just doubling up the risk. If you do want to diversify, you choose from branches of the tree which are far apart, such as a fund within this group and a fund within this group. But generally, just like equity, REITs tend to be highly correlated. In fact, almost all of these correlations were above 70 or 80%. And for this cluster down here, the correlations were well above 90%. So if you want to diversify REITs, the best way to do that is outside the asset class, either treasuries and to a lesser extent equities. Now, as we said, one of the primary purposes of REITs inside a portfolio is to generate income. And to look at income, we typically look at a number called dividend yield, which is the income generated by the fund over the last 12 months divided by the price today. Now, after a big sell-off, dividend yields tend to spike. To see why that's the case, if the price falls today, the income will not change because the income varies very slowly. And if we're dividing by a smaller number, then the dividend yield will increase. So just bear that in mind when we look at a snapshot of the dividend yields for those US funds as of June the 9th, 2020. Notice how the mortgage REITs or M-REITs tend to have the highest dividend yields. And if we plot the return from the market peak in 2020, which was on February the 19th, the funds which have fallen most are here on the left-hand side. And sure enough, those are the mortgage REITs. So don't necessarily be drawn in by high dividend yields. It may simply be that the prices have crashed recently. You should always also consider whether the dividends will be stable. Will the source of revenue for this fund continue generating revenues during a crisis? Now let's consider UK REITs. The London Stock Exchange has this list in a section called its Real Estate Hub. And just like the US, there are various sectors in which you can invest. Industrial REITs, office REITs, residential, and so on. But as usual, the UK market is much smaller and less diversified than the US market. If we do the same exercise with correlations for the UK funds, and for good measure here I've also thrown in the life strategy funds and a global equity fund, VWRL, you can see that UK government bonds are a very good diversifier for all of these REITs because they're on a completely separate branch here at the top of the tree. So if you do want to diversify your REITs, or your equity for that matter, either a pure government bond fund or a fund which is 80% bonds would be a good way of achieving that. Now let's look at some of the REIT risks. A standard way of looking at risk is to look at the typical annual price move, or the volatility of a fund. Now the really risky funds here are the ones which are 3 times leveraged. Personally, I don't think these should be made available to most investors. They have fairly toxic properties, and they also come with an extremely high volatility. Emerging market real estate funds also have a high volatility, as you might expect. So this is a specialty MSCI China real estate fund, and mortgage REITs are also higher risk, as we've already seen. The funds which tend to have the lowest risk are the ones which are globally diversified, here at the bottom of the graph. And there the volatility is just 25%. What that means is, in a typical year, the fund will either move up or down 25% a lot of the time. So if you feel you can't stomach a 25% loss, and for 25% you really shouldn't bat an eyelid, then this isn't the asset class for you. And remember, this is the safer end of the spectrum. These funds up here are much more risky. Now, because it's a risky asset, like equity or corporate bonds, it tends to be linked with economic growth. So if we look at the Wilshire US Real Estate Investment Trust Total Market Index, which you can find using this link here at the bottom on Fred, notice how during a recession, which are the grey bars, the annual return on REITs tends to be negative, although that's not always true. So for example, the recession just after the dot-com boom left real estate largely untouched. So when you do buy REITs, a recession is probably going to hurt your returns. But coming out of a recession, REITs tend to do well, as you can see here in 2009 and 2010, after the global financial crisis. Another risk is a lack of liquidity. If you want to sell a hospital or a shopping mall, the market is usually quite small, and it may take the fund manager a very long time to sell that asset. So during a crisis, when shareholders are selling their REIT shares, the fund manager may not be able to sell the real estate quickly enough to return the money to shareholders. If that happens, the fund usually gets gated, which means that you're not allowed to pull out your money. And during this crisis in March 2020, that certainly happened in the UK, with this article from the FT saying that about £13 billion has been trapped inside UK property funds. A nice quote from this article is from someone who says, "What's the value of a pub, a hotel, or retail premises if you can't use it? What's the valuation of an office if no one can get into it?" So working out the fundamental value of one of these REITs during such crises becomes extremely difficult. So let's look at how much REITs fell in the United States during this crisis. If we look at the peak to trough fall, you can see that there have been fairly hefty falls all across the REIT universe, with the biggest falls, yep, you guessed it, in the mortgage REITs. And if we look at the relief rally after March the 23rd, the funds which fell the most here at the bottom are usually the ones which rallied the most following the sell-off. However, because the falls were so large, the rally wasn't enough in many cases to put the price back to where it started. For example, If we look at Mort, which was the fund that lost the most here at the bottom, and it lost about 65%, in the rally you can see that it gained about 60%. But combining those two returns still ends up with a 44% loss. In fact, to get back to where it started would require a return of 184%. So even though it's rallied a lot, Mort is still down about 44%, and these other two mortgage REITs are down about the same amount. If we do the same exercise for the UK, with the falls since the peak here on the left, and the gain after that March the 23rd bounce, again we can see that many of the funds haven't got back to where they started after such a huge fall. So REITs are certainly a very risky asset in this kind of environment where people are worried about growth. So what might we expect with REITs in the future? In the near future, while we're still worried about this crisis, the immediate concern is that customer-facing service industries such as shops and restaurants have been particularly hard hit by the lockdowns. Because they've generated no revenue, many of them have been reluctant to pay their rents. So while these service industries have been badly affected, so have the landlords and the REITs, which own the properties where these tenants run their businesses. Looking beyond the crisis, we could see some cultural changes which won't be good for the real estate market, or at least certain sectors of that market. Now, the Norway Oil Fund has diversified into global property and away from oil, and it's quoted in this article as saying that it expects lower returns for its property portfolio over the coming decade. And the sectors which they say will be most hard hit are retail and office sectors. Retail was already in trouble before this crisis because of the move to online retail. But during the lockdowns, one of the ironies is many companies realize they don't need people to show up to an office, and they can actually save money by having people work at home. And that would be a cultural shift which would hurt the office sector for REITs. So if you do think the economic situation is going to improve, REITs are certainly one way in which you can get exposure to that upside as we come out of the recession. But if you do think things are going to get worse, then maybe it's not such a good investment. So that's what the Slack application looks like. If you join us as a member, you get access to that. You also get access to our live webinars and the notes we make for those webinars. And we've got a growing library of video content which is only available to Patreon supporters. So if you do want to support us and join our community, just click on that Patreon link over there. It's very easy to sign up and it's just $10 a month. And as always, thank you for listening.